Hi everyone, my name is Erica Carey. I'm from Renewed Living and I am back with financial professionals Kim Dickie, Grace Tan, and Mary Jane Cantaoe. And they're going to present their part two presentation on affording your retirement and estate planning. So welcome.
Thank you very much, Erica. Yeah, my name is Kim Dickie, and I will just share a little bit with you about how I got into the business. I decided a couple of years ago that I wanted to semi-retire and found out very quickly that there was a lot more money going out than was actually coming into my bank account. I'm not quite sure how I thought the money was going to get there, whether I thought it was just going to magically appear, but was at that time that I actually met Grace, who is on this call, and she helped me get my finances straightened out. And I realized that there is really a lack of education in Canada. You know, we don't learn these things in school. You know, they don't ever tell you how to make your money grow or how to prepare for retirement. They just let you know that you do need to prepare for retirement. And so, you know, if I can share that knowledge with other people in the country and just, you know, educate them on how it actually works, that is great. And that is exactly why I am in this business. And I believe that Mary Jane's going to introduce herself next.
Hello, everyone. My name is Mary Jane Cantaoe. Actually, I've been in the business for 5 years already. And what got me here into the financial industry is the mission and vision of our company, helping people from all walks of life build a solid financial future. And next is my mentor and friend, Grace Tan.
Awesome. Thanks, Mary Jane. Hi, everyone. My name is Grace Tan, and I've been in the financial industry for 16 years, 16 as of May of this year. And so what drew me to the financial industry is actually the fact that I had no idea. I didn't have literacy, and I was starting working. And just like Kim said, you know, you hear that you should save, but then you don't even know where to start. And that's why I wanted to know more. And also at the same time, I noticed that my parents worked really hard, but they didn't even know what questions to ask, so they didn't, right? So they never took advantage of any education funds or you know, retirement. What does that look like? So that gave me reason to learn more for myself to help my family, and then now, of course, I get to help other families go through that. So I know what it feels like to be on the other side, right? And I love that we get to empower people with knowledge and have informed choices and not feel, not feel overwhelmed, or at the same time feel like, I know a lot of people lack confidence, so they don't know where to start. And so for us, our goal is to just meet people where they're at and give that empowerment and confidence. So I'm excited to share with you guys here. Thank you, Erica, for having us. And in terms of, what we do, and we'll get started with Kim.
Awesome. Thanks, Grace. So we're just going to review a few things that we talked about last time, just to start out. So our process is we sit down on our first visit, we go over some basic concepts and find out what our clients' goals are, like what are their hopes and dreams for themselves and their family. And then on the second visit, we sit down and we just go over a little bit more in detail your goals. We're going to look at your budget. And then we'll do a financial needs analysis. And basically the financial needs analysis is a 6-step process. And I'll be going over that in a little bit here. And then on the third visit, we're going to sit down and we're going to have some analysis and some recommendations for our clients based on what they told us in the second visit. So one of the great things about our company is we do not actually have any of our own products. We work with and market for the large banks, the investment firms, and insurance companies, all companies that you've heard of, you know, and trust them. And some of them have been around for over 100 years in Canada. So what is our financial needs analysis? The first step is we're going to look at your cash flow. how much money do you have coming in and how much money do you have going out? And is there somewhere that we can help you out to make sure that you have a positive balance at the end of the month, right? We want to make sure that we have money left over at the end of the month. And the second step is protection. We'll look at a protection that you have. And by protection, we mean insurance. So we want to make sure that your income is covered if something happens to you and you're not able to work. So this is things like life insurance, critical illness, disability, right? Let's make sure that we're protected. Our income is protected. And again, if you're not able to work for a period of time, that your family, doesn't lose out on that income. And then the third step is debt management. This is huge. Everyone's always talking about they want to get out of debt. And, we talk about it every year. It's our New Year's resolution every year, and it never happens. So let's make that happen for us, and we can free up some more cash flow that we can put now towards savings possibly, or again, towards protection. The fourth step is an emergency fund. We're going to help you put together an emergency fund. We suggest 3 to 6 months worth of income put aside just for, those things that come up, things like new brakes on your car, or maybe you need to buy a new washing machine, right? It's important to get our laundry done. As well, we've all seen what's happened over the last year and a bit, right? People are losing hours at work. Some people are even losing their jobs completely. So, if you've got some money set aside, that's going to help you out with those emergencies that come up. The fifth step is asset accumulation. We want to ensure that any money that you are putting aside as savings is growing at a pace that is going to outpace inflation. If you've got your money sitting in the bank and you're getting a percentage of 1% return on your money, and the rate of inflation every year here in Canada is 3 to 4%, then you're actually losing money every year. So let's make sure that that is not happening, right? We all work really hard for our money, so we want to make sure that it stays in our own pocket. And then estate preservation is the last step. We're going to look at what your final wishes are. We're going to make sure that you've got everything in place so that the cost of you passing away, and unfortunately there is a cost to pass away. We want to make sure that that is not being, that's not a burden on your family. Let's make sure that that cost is taken care of. All right, now we're going to take a little bit of a look at asset accumulation. So the wealth formula states that money plus time plus or minus your rate of return minus the taxes minus inflation is how we calculate wealth, right? It's not strictly just money in the bank that is an indication of your wealth. You have to take in some other factors as well. And we're going to take a look at the rule of 72 quickly here. The rule of 72 talks about how long it takes your money to double based on the rate of return that you are getting. So if I have my money in the bank in a savings account, and if I'm really lucky and I'm getting 1% return, which we know is not happening in the banks, it is going to take 72 years for my money to double. Now, I don't know about all of you that are watching this, but I do not have 72 years left to wait for my money to double. So we're now going to take a bit of a closer look at how this works. So if I have my money invested and I'm getting 4% return, now my money is doubling every 18 years. So 72 divided by 4 is 18. So at 29, if I have $10,000, at 47, I have $20,000, and then another 18 years later at 65, I have $40,000. Now, I don't know about you, but that is definitely not enough money to retire on. Again, if I am getting a 6% return on my money, you're going to go 72 divided by 6 is 12. So now my money is doubling every 12 years. At 29, I put in my $10,000. At 41, I have $20,000. And as you can see, at age 65, I'm going to have $80,000. Now, that still is not enough money to retire on. If I am getting 8% return, my money is now doubling at 9 years. And at the age of 29, I will have $10,000. And if you follow through, at 65, I will have $160,000. It's still not enough to retire on. So if I am getting 12% return, 72 divided by 12, my money is now doubling every 6 years. So at 29, I have $10,000. At 35, I have $20,000. At 41, I have $40,000. At 47, I have $80,000. At 53, I have $160,000. At 59, I have $320,000. And at age 65, I have $640,000. Now, $640,000 probably is not enough for you to retire on, but it is a lot closer. So with the rule of 72 and with your rate of return, you can see how much that affects the amount of money that you end up with, when you're ready to retire at 65. Now, we cannot guarantee that we can get you 12% every year, but if we can get you between 6 to 12% return every year, isn't that a lot better than having it sitting at the bank where it's not even getting 1%? So again, if you have any questions about that, we're more than happy to sit down with you and just show you how that works. So next, I would like to pass it over to Mary Jane. So take it away, Mary Jane. Oh, sorry.
Thank you, Kim. So hello, everyone. So you've learned from the previous slide with Kim about the wealth formula, okay? And time plays a big role in building your wealth. So no matter where you're at in life or in building a financial strategy, right? Discipline and consistency are some of the keys. And the most important thing is to begin saving now. Okay, so let me ask you, at what age do you want to retire? Age 65? Earlier? Or earlier, right? So on this example, okay, here's an example of how much money you need to save every month to reach 1 million in an 8% tax deferred account. Okay, so if you're planning to retire at age 65, or age 60, okay, and if you have 40 years left to reach your retirement year, so it means that if you're planning to retire at age 65, it means that you're 25 today. Okay, let's go back in time. 25 years old. Okay, so you're going to set aside 286 and 45 cents a month, and 35 years left, right? That's 435. And then if you go down here, if you have 20 years left to reach your retirement years, you're going to set aside 1,697 a month. And, as you can see here, 5 years to retirement, okay, 13,000 plus a month, okay? So if you think of it, if you look at it, right, who can do this? Especially on this one here, down here, 20 years left to retirement. Not many people, right? So as you can see, the younger you start saving, the better. So don't procrastinate. Start saving early. And if someone asks me, when is the best time to invest? It's yesterday. And next is today. Okay, so start saving now. So taxes, of course, in Canada, we pay a lot of taxes. So imagine today, you take $1 and double it 20 times without taxes, you're going to get 1,048,576. And take the same dollar and double it 20 times. This time, every time you double it, you deduct 33%. Do you get a lot less or little less? And you get 28,000. That's a lot less. Isn't that crazy? Isn't that crazy? You lose $1 million because of taxes. Because they say that taxation is potentially the powerful challenge, facing your investment. because when you earn it, they tax it. When you spend, they tax, right? When you save, they tax. And when we die, they're going to tax us the most. So what we want to share with people is understanding taxes makes a huge difference. And most of the time, people only focus on a better rate of return, but they don't think about how to reduce taxes to grow their money. And we share with people that if there are ways that we can help to minimize these events, that means that more money for you and more money for your family. So we just learned the importance of understanding the impact of time, right? Rate of return and taxes, and making sure that you put your money more in a tax shelter strategy. And the reason being is you want the most money in your retirement. And the goal of growing it is so that you don't need to worry about your income at retirement. Okay, so now you're 65, okay, you're retiring. Now you want income, okay, at your retirement. So how does it look like? So if you don't have enough, right, if you don't have enough, you might need to downsize your home as an option to get more investment. And there are two types that you can put your money in. The first one is annuities, okay? This one is a contract between you and an insurance company in which you make a lump sum payment or series of payments, and in return, you're going to receive regular guaranteed income for the rest of your life. Okay, and the second one is investment that pay a monthly income, but this one it's not guaranteed and it's based on the market. So this is an example. Okay, so of course for both of this one, they can give you an average of 5%, right, or 7%. Okay, but on this example, 5%. Okay, so if you put in 250K, that's 12,000 a year, and it will give you 1,000 a month. And if you put on 500, right, it will give you 2,000 a month. And if you put on 1 million, it will give you 4,000 a month, right? So if you look at this, people think that they have a lot of time to do this, but really, right? Not really. As we showed on the previous slide, right? The younger you do it, okay, the more it's doable, because time, as what I've said earlier, plays a factor. And as you can see, even if you have 1 million here, that's only 4,000 a month, okay, without depleting it. But if you take out more, it will not give you the guarantees that you can have it, all your life. Okay, so if you have any question for this ones, okay, we're going to, we'll be happy to sit down with you. Okay, so now my mentor and my friend Grace is going to share about estate planning and preservation, because of course, one day we're going to pass away, right? So in Canada, when we pass away, we have estate taxes and probate taxes. So how can we help people minimize that when this event happens? So Grace, take it away.
Awesome. Thank you, Mary Jane. Let's give her a hand. Yes. Yeah, actually, whenever I look at that, I realize, oh my goodness, it is very important to set money aside as soon as possible. And it's not even, it's not even about living luxuriously. It's making sure that there's enough and that you could retire with dignity and that you don't have to worry and have peace of mind. So, so hopefully that enlightens you, and we're more than happy to share with you more about it. So with estate planning and preservation, just like Mary Jane mentioned, we want to make sure that you work so hard for, building that for you and your family. We want to make sure that your wishes are honored, and that, in case if anything happens, your financial affairs are resolved quickly, and your loved ones, where they don't have to worry too much, and that basically, more of it will go to your family than to your estate. Okay. The other thing, of course, is, what kind of documents that will help aid in this as well, whether it's a will, choosing an executor, arranging legal representation, things like that, setting up trust for a child. Those things are important to consider. And these kind of things, definitely, we're not there for legal advice. We're here just to share with you what are some of these things. You would go to a lawyer for legal advice. But we do have programs financially that includes will preparation, things like that, but we do not give legal advice. So I just want to make sure that that's there. Go to a professional lawyer for that. Okay. So for us, of course, the best person to direct the details regarding your legacy, assets, children, and medical decisions, you want to make sure that it's you, that it's your wishes and not the court. And when I talk to my lawyer friend, basically she shares that if there's nothing written, they don't know what you really want, and they're going to have to just base it on evidence of what's here. So we want to make sure that that's clear, right? And so a couple of key things, definitely getting your will done, a must, right? Especially if you have kids, right? It's important to have that there. Of course, you get to direct exactly who you want that, your wishes, your assets to go to, and also so that to prevent any kind of, conflict, right? Making sure that that's clear. Number 2, enduring power of attorney. This is, when you are not mentally capable of making that decision, you want to make sure that somebody that you care about, that you choose to represent you, to make those decisions for you financially, you want to make sure that there's that, what we call enduring power of attorney. Okay, the other one is representation agreement, such as your health directives. So again, when you're not mentally capable of making that decision, that you have somebody who knows what you want and your wishes are laid out, and that they would do that when you're not able to make that decision. And then the last thing, making sure that there's discretionary trust, if that's something that you desire. If you want to set that up to provide for children with disabilities or young children, and how you want that laid out, where a trustee is involved for them. Okay, so those are some things to consider. We're just touching on them, and again, go to a professional lawyer for a more deeper legal advice in regards to this. What I am gonna touch on is, that they are important, and it's important to get those things done and looked at. But I'm going to move towards some of the different things in terms of where your investments could be in, and how it affects your estate planning. Right. So most people know mutual funds, right? The reason being is that at the banks, that's what they offer, and that's what they can offer. Whereas for a financial professional, you could, if you have both licenses, you could offer both mutual funds and segregated funds. And segregated funds can only be offered through an insurance company. And so that person would have to be licensed in that. And that's why at the banks, that's a separate department. So that's why majority of families may not be able to have heard about segregated funds unless it was talked about with their insurance professional or insurance advisor. Okay, so I want to touch on some differences when it comes to like estate planning. So if something were to happen, actually with mutual funds would go towards the estate, whereas with segregated funds, it would actually skip that and goes directly to the beneficiary, right? So some of the things to consider is that there are surrender fees in mutual funds, if that was the case. If there's no beneficiary, up to 6%. Probate fees is up to 1.5%. Legal fees may be up to 5%, as well as accounting. And there's no death guarantee. There's no creditor protection. And at the same time, it goes to the state before it goes to the beneficiary. Whereas with segregated funds, all of these fees, surrender fees, probate fees, legal fees are not applicable. So you don't need to pay, because within somebody passing away a couple of weeks, that those funds will go towards the beneficiary. So it's one could take up to a year, and segregated funds with mutual funds and segregated funds could be within a couple of weeks. So that just shows you the importance of where do you want your money in. Right. And so to touch on a little bit more as an example, don't worry about the writing too small. I can just share it. And so, for example, let's just call them Jim and versus Joanne. Okay. And they both have 250,000 lump sum in non-registered investments, so open account. Right. And Jim has it in mutual funds, and Joanne has it in segregated funds that has 100% death benefit guarantee. So it has that extra protection in a segregated fund. They both pass away suddenly, and their investments have actually gone down 10%, right? So minus 25,000. So from 250 to 225,000. Okay, so that's where their investment is at. For Jim, because it's a mutual fund, the investment went to this estate, right? This is like non-registered, so there's no beneficiary yet. And it's incurred fees, and took basically almost a year to settle. So the surrender fees could be up to 5%, so 12,500. Probate fees could be about 2,875. Legal fees about 10,000. Accounting fees about 10,000. So at the end, from 250 and it went down to 225, right? The total would be 189,625. Wow, so that's a 60, well, I'll talk about the difference. It's about $60,000 in difference, but I'll share Joanne's situation in segregated funds, and there's 100% death guarantee. The investments paid to the beneficiaries within a couple of weeks after passing away, avoided costs and delays, surrender fees, none, probate fees, none, legal fees, none, accountant fees, none. And then whatever was missing, because there was a death guarantee, even though it was 225, they were able to get the full 250 because there was a guarantee there that's in segregated funds. So people don't know that this exists and there's a big difference between the mutual fund. They're both in the same, place, right? Growing the same way. And there's a big difference in terms of estate planning. It's actually a $60,000 difference. So if there was more money involved, the difference will be even more. Okay, so if you're curious about learning more about what's this segregated funds all about, we're more than happy. Reach out to us, and let's have a conversation about it and see if it's a good fit. Basically, our closing thoughts is that we want to let you know we will take the time to educate and walk with you hand in hand each step wherever you're at, whether it's asset accumulation, discipline building, emergency fund, wealth building, income at retirement, estate planning, making sure that certain things are in place with your documents, making sure your hard-earned money goes to your family because you worked hard for it. And we want to make sure to protect that. So we want to make sure that you are empowered with the knowledge you need to make informed choices. So we just wanted to say thank you for this opportunity to give some education out there. Definitely it's more of an overview. And of course, each person, each family, your case is particular to you, which is why we would take the time to custom build your plan for you. So thank you so much. And thank you again, Erica, for having us.
Thank you for joining me and being here. Thank you.